one of the keys to investing is understanding what you own, um, and not from the standpoint of I own stocks and what is a stock, but when going back to how I originally started investing, I've always been an index, like a passive index investor, and just I don't know. I was always an admirer of Jack Bogle at Vanguard and what he was doing, and a lot of that makes perfect sense. And 90% of me thinks that a majority of my investment investing should be done that way. Mostly because it's more passive, and just that that being passive, you have less to think about and worry about. And then the other side of it is just all of the arguments for passive index investing, where you know active managers, 80% of active managers underperform the market, um, which I would actually like to deep dive into that, or at least look at it a little closer, because is that I'm maybe if you know, you can let me know. But I've always heard that statistic, and I think, is it unfair how they're being judged? Because not all active managers are really trying to outperform the market necessarily, because they're all different reasons for different strategies. You may want to, anyway, other strategies have other reasons. So you have to compare apples to apples. Like if you're comparing everything to the S&P 500, some portfolios you would not make that comparison because that's a completely different type of portfolio. Anyway, um, my goal here is to learn, and I I just have this curiosity about investing, and to me, it's starting to make more sense to take advantage of opportunities you see in the market, um, whether that's um, sector related things. I don't want to say I'm a macro investor, but I think zooming out and looking at macroeconomics occasionally makes a lot of sense. But what is it? There's some quote, I forget what the quote is, but it's basically saying that it's pointless to try and invest based on macroeconomics because it's so complex and you can't predict it. Almost every time you try, you'll be wrong. So, so from the like Peter Lynch standpoint of buying into the stories of different companies, uh, that seems to resonate a lot more with me now, and I would like to be doing more of that, at least within the context of companies that I know and maybe interact with, or more familiar with. So overall, what I'm saying is, I want to have a large base, a significant portion of my portfolio be, you know, passively indexed across the market, and then a smaller portion of the portfolio be individual picks or individual bets that I make. Um, I hate calling them bets because I want to think of them more as strategic decisions, not so much gambling. So bet may not be the right word. So something I ran across recently was J.L. Collins' blog. He wrote The Simple Path to Wealth. Um, in reading through, at least in what I've read so far of his methodology, or his philosophy, is that all you need to do is buy Vanguard's total stock market index. He recommends this VTSAX. Now, what he's doing is recommending this is the entire stock market. The thing is, this is a mutual fund, I believe, which I kind of find it interesting that he still is recommending that. I guess he's sticking to his age old advice. He probably has addressed this. I just haven't found it. I haven't looked for it. I haven't thought to look for it until just now. But this mutual fund has a minimum investment of $3,000 for the Admiral shares. You can also, it's telling you here, you can also buy an ETF that's the same thing, but you can buy just a single share of VTI.IV, which is interesting. It has a smaller expense ratio, so I'm not really sure which makes the most sense. In any case, I'm splitting hairs at this point. But his big thing was just that the simple path to wealth is having as much of a savings rate as you can possibly do and investing in the entire stock market. And I'm inclined to agree with him. I think that's right. I think VTSAX, I think, let's see what well, this is actually related to what I was about to talk about. So you can see the top 10 largest holdings are here. If I want to see the portfolio holdings, I can go here. Does it hold bonds? Okay, so it's all stocks. It's 3,949 holdings right now. And they're all market cap weighted, which means like the largest company has the largest share of the portfolio. But so the case for this is as these companies climb in size, they take over more and more of your portfolio as you pile money into this fund. And then as they do worse, they fall lower into your portfolio. I really like it. I mean, it's extremely diversified, extremely simple. It's a one fund portfolio. He says later you could add bonds as you near retirement, but he also kind of backs away from that now in the current environment with bonds, and I'm inclined to agree with that as well. And he said something about just increasing your cash position, which makes a lot of sense, and it made me wonder. Should this be my metric to beat? Basically, the entire stock market, one of the, like this fund, VTSAX, and then like I don't know, 2 years or some cash reserve of 2 years of expenses, or something like that, where you have like a significant amount of cash. And then the idea is if the market is doing well, you're drawing from your investments and maintaining that cash reserve. And then in the event of a downturn in the market, you stop drawing from your investments. So that way you're not selling at a low price. So so this is where you have to make a guess like how long a bear market might last. Bear market meaning a market that's trending downward. So, but I mean, you could do that. You could have like 5 years of cash sitting on the sidelines, and you do that as a kind of a bond allocation. If you are going to need to draw upon your portfolio. So you keep a reserve of however many years of expenses. And the idea behind that is you can stop drawing on your investments in a downturn, and then when the market turns around, you can start drawing from your investments again. And replenishing that cash reserve as it probably got low or even ran out during the downturn. Anyway, I haven't thought through that entirely, and I just thought it was an interesting, very simplistic portfolio and probably really easy to manage. You just open a Vanguard account, you buy this one fund. You could even I believe you can keep cash in like a money market or like whatever the default is probably a money market account with Vanguard. If there were some other way to earn interest on your cash, I mean, in the traditional finance world, there really isn't right now. But you could. I don't want to say you could. I am choosing to do other things like stable coins in cryptocurrency, which have their own risks, and it's not the same as like cash in a bank. So they shouldn't really be equated that way. But I think of things in terms of, and I'll probably talk about it in another video, but like I think of things in terms of short-term savings, long-term savings, and investing. So you could have like short-term savings in banks, long-term savings in stablecoin earning interest. And the idea is like if something goes completely wrong, you still have your short-term savings to save you as a safety net, but you may not have the money you were setting aside to buy a new car. Like you would just go without, like if you lost those funds or something terrible happens. So I'm not even sure that that's going to be my strategy or not, so don't hold me to that. Anyway, let's get back to what I did recently is, and I guess getting back to knowing what you own. When you own just one fund like that, you could easily look at the holdings on the Vanguard site like we were reviewing and see the companies you own. But let's say you have all these different accounts like I do, where it's, retirement accounts and this account and, old retirement accounts in different places that you haven't rolled to the same brokerage maybe. In any case, I just had a whole basket of funds, lots of different ETFs, and it's like I couldn't really. You can use tools to show you like what your allocation looks like, but what that's really just telling you is like, hey, you're in these funds. It wasn't getting specific enough, and what I decided to do is grab all the data from the brokerage accounts for, gather the holdings for each of the funds that I owned. And I created a sheet so it would, it lists all of the individual holdings within the funds that I have. And obviously I don't have a ton of money in this account. I mean, it's $3,000, about $3,000, but so a lot of, like the value of each ticker, combined value. Anyway, this took a little bit of doing, but because some of the funds own some of the companies that I have individual holdings in. So like these are the three funds. So here's the data. And then these are my individual companies that I owned, and that's, in any case, I don't want to walk through the whole thing, but this shows company weighted, or how do I say this? It shows it's a representation of the dollar amount I own in each company. Because technically I don't own those individual stocks. I own the funds that own those individual stocks. So there is a distinction to be made there. But what I did is I built this chart that shows me, and this struck me as pretty funny at the time, because I just didn't realize that the Disney I had bought, I felt like it was a good deal at the time, so I bought more heavily into it. I mean, these aren't huge numbers, right? But what's funny is I went down the list and I said, okay, this kind of makes sense. I maybe didn't know Disney was so far out of whack. But then if you go down here, I didn't realize that, what is this? 1, 2, 3, 14, 15. I didn't realize that the 15th largest holding was Philip Morris. I don't know. I just didn't, you know, when you look at this, it tells you nothing. This tells me nothing. I can go in here and I can see that I own these funds, and I know that I know this is made up of high dividend paying companies, and this is made up of Vanguard real estate. But it's like, what companies were in here? And actually, Store Capital is also in this fund. If this actually had but this is made up of high dividend paying companies as well as some REITs. So I was really proud of this. To me, this is the way you would want to view all of your investments if you could get it into that. I'm just surprised a tool like this doesn't exist. So that's why it didn't exist. And for like 2 years, I kept coming back to it thinking, oh, wouldn't it be nice to be able to see this? And I finally did it. It took me quite a few hours to organize. And it's only of this one portfolio, but it would be really nice for me to come back and do it across all of my accounts. It'll just take a significant amount of time to do. But I started with one, and I'll do more. Also, just considering what J.L. Collins was saying, it makes me wonder if I should really review all the accounts and oversimplify or do more to simplify my portfolio. Like, I have a Betterment account that I use pretty heavily, and I used to really like the idea of the robo advisors. But I almost wonder if they're just there's too much diversification. It's like, if you're just starting out, like I'm kind of starting out with this account, it makes sense to just buy individual stocks, and then once you get to a certain dollar amount, like, I don't know, 10,000, 50,000, I don't know, at some point you decide you want to diversify into more than just maybe your 10 or so stocks that you follow fairly closely. You might have 10 or 20 that you do more heavy, like just do heavier research on, and then the rest, lion's share of like your portfolio value or contributions would go into like a total stock market fund that would diversify you across thousands of companies. So I'm kind of doing it from being really diversified from the start and then weighting individual funds. I don't know if it's really necessary to do it that way if you're just doing a little bit of money to start. I guess it just kind of depends on how you feel about the diversification. Just makes more sense with a larger sum of money. I'm probably wrong at what I'm saying, but that's just a thought that came to me just now. In any case, this is neat to also look at. You could also just look at the holdings and the value of each holding within a spreadsheet or within the like Vanguard site. If you had this fund, you could see, okay, this is in order of the amount held in the actually, is it? Yeah, because it's in order of market value. It's sorted by market value. So you could start here and just research each of your companies in order of how much you have weighted to those companies within the fund you own. So I'm going to try and spend some time doing that, where I start at the top of this list and work my way down. Let me know what you think. I guess I should show my other accounts. My daughter's account, I added some to. I think I added like $500 at that time. I should stop doing that. What I was doing was with the child tax credit that they're mailing out monthly, I was just putting into her account, which she's too young to have money come to her that easily. I need to be careful about that. So I'm going to probably stop doing that and let her contribute to this. So in addition, I opened an Abra account. I actually don't know if I have a web login for that, but I've done it on my phone. And the reason for that was to have another Bitcoin wallet, even though it's on an exchange. I did it so that she was interested in Bitcoin and wanted to buy or invest in it. And I said, that's fine. And so I opened a separate account because it was hard. It's hard. Like I felt like having a separate location was best because I couldn't create a separate account for her within one of the exchanges I already used. So I opened an Abra account and it's earning interest. She's lending out the Bitcoin she owns, which is very minimal, but it's still earning interest. Also, I thought about using that Abra account to have another place for stablecoin. So I would own like USDC stablecoin in the Abra account and then Gemini USD in the BlockFi account. So that spreads some risk because so I have two different currencies across two different, I guess they're called exchanges. So this is her account. We were doing individual investments of companies that she is familiar with or likes, and then I would show her how to buy, we've talked about it before, but I didn't know much about the video gaming industry, so we bought an ETF for that. So my growth and innovation fund is down overall. It's up today, down for the week. I think most of these, especially, so showing, I bought some Alibaba. I'm probably going to continue to do that right now. I feel like Alibaba's stock price is being unfairly punished, and I think it's a deal at the moment. So I will probably be buying more of that. And so this will look out of whack for a while, but that's okay. But that's how we're treating this account. So yeah, that's kind of the update as of now. Hopefully you'll take some time to kind of look over what you own and know more intimately the companies that you own and understand what it is you're buying when you buy the diversified index funds that you buy. It's probably not necessary, but I think it's good to just have a better understanding. And frankly, I find it interesting. I mean, knowing about the companies and knowing who's working so hard to increase your wealth. I mean, understanding that and having respect for that is it's a lot of fun. So yeah, there we have it, and let me know what you think.